So I think the deadline will be extended. I don't think they're going to reach a deal anytime soon, but I do think there will be an extension during which they will test the grounds further.
Well, Vadim, for the last 3 weekends in a row, we've gone into, some sort of vote, some sort of tabling, and every Friday, it's always the same story. We'll get something done. It'll be fine. We'll get a vote. No, it'll be a no referendum. Are you that confident this time, this Friday?
I'm not that confident. But on the other hand, I'm not sure how I would change my positioning if I absolutely knew that the deal is not getting done. We're basically neutral to somewhat underweight Europe. We're underweight. We're neutral on risk assets in general. So at this point, I'm not making a significant portfolio allocation on either outcome because I just don't think it's particularly researchable.
Interesting. Are you hedging? Are there any put options you're buying? Are you shorting any currencies just in case?
Yeah, we are underweight euro. We have increased some exposure to bonds, which tend to do well in a sort of slower growth, risk-off environment. I think really you have to look through this. You have to look at the fundamentals. One of the interesting things, despite all this turmoil, equity markets globally are down less than 4%. This is hardly a crisis. The issue is, will this affect European recovery? And there you starting to see a little bit of an issue as the confidence in Europe started to decline, particularly in Germany, and growth may start to slow.
Well, the IMF is still pegging 3.3 expansion GDP growth rate this year, which to me doesn't sound that weak. Vadim, but okay, so tell me though, Europe, you're being underweight because every other investor that I've spoken to in the last 2 weeks are actually overweight Europe because you have growth once again. The ECB is pumping money and it's cheap on a valuation metric compared to, the US.
Yeah, I agree with everything except cheap. The run-up in Europe has actually caused it to trade pretty much in line with historical discount to U.S. It has pulled back a little bit more. The way we're looking at Europe right now, we have only a slight underweight, but within Europe, you are starting to see valuation spreads. And some of the more cyclical, smaller cap stocks, I actually think present a tremendous opportunity. So it's less about the overall European index and much more about the opportunity in some of the more beaten down, smaller cap cyclical stocks where we see significant opportunity.
Okay, well, does the Greek turmoil, does the China market collapse, does it filter into the Fed and possibly delaying interest rate increases this year?
I'm not sure. At this point, I don't think that's going to be the case. But we are starting to see some slowing in the economic growth. The most recent wage numbers in U.S. were a little bit off. It could be a statistical artifact, and we could start to see a recovery in the next month or two. But I do think this sort of straight up type of recovery that we've been witnessing since the beginning of the year has started to slow a little bit. Whether it's China, Greece, consumer confidence, business confidence, it's tough to trace it to a single cause. But I do think that the Fed is probably a bit more data-driven today than they were, let's say, 3 months ago when everything looked quite bright.
Okay, from what I see, though, Vadim, I like the energy and commodities call. That's bold, given that we're at 14-year lows or close to them on the commodities cycle. But financials, that's your second long-term ideas. You're saying they're attractive in terms of valuations. But wouldn't they look even more attractive? Wouldn't you buy into financials more if you actually had the Fed hiking interest rates for sure this year?
Absolutely. And so that's why it's a bit of a longer-term call. Many of the financials are going to be positively correlated with rates, at least initially, until we get into much higher levels, particularly life insurance. A lot of the companies that have very large money market funds, all of those companies would react favorably. Since I still think the Fed will have at least one hike between now and the year end, even though it may be delayed by 3 months, I think that's being way too cute to try to add exposure to what is a fairly attractively valued sector, trying to guess, a 3-month difference in the timing of the Fed hike.